Hey everybody, this is David Skrika's stock chart of the day. So today we're just going to look at a quick chart here, and this is going to be a very short stock chart of the day because my last few ones have been very long, so I just want this one to kind of be short. But this is like, look, this is why I don't get political on things. This is why you have to just look at where we are historically. So what we can see here is, this is my favorite indicator, market cap to GDP, Warren Buffett. So it's a Wilshire 5,000, which is every basically publicly traded company in the United States to GDP. And we can see that the mean of this is about, I think about 80%. Now that's moved up too. It was 65% about a decade ago, but because we spent so much time, like one reason that I got worried back in 2014, 2015 is that we were hitting these 115, 117. It was the highest since, the dot-com bubble. Now, I never in my wildest dreams thought we would go back up to the levels of, the dot-com bubble, then even higher. So in 2021 we went to, almost 200% of GDP, and now we're over 200%. Now, what's interesting, 2001 we kind of did that because interest rates were zero, so stocks could kind of trade at a little higher valuations because interest rates were zero. you know, and a lot of these stocks that benefited from people staying inside, buying things online, kind of got these bloated valuations because of COVID, right? So that's what happened there. And then the Fed started raising rates, and we only went back to 141, which is essentially where we were at the high in 2000. And now we're back up here. So look, if you go look at this as a long-term indicator, now it doesn't mean overnight. Like you can see in 1974, when the market bottom, it was 36. It was still 33% in 1982. So stocks didn't immediately go higher, but it just told you during that whole period, just accumulate stocks, accumulate stocks, accumulate stocks. And of course, for the next 20 years, they went great. And then in 2000, when we got this crazy level, we went back down to about 50% in 2009. The S&P, bottom at 666 was 1,500 here. And of course, adjusted for that 9 years of inflation is even lower. So it fell like 60%. And then, and then of course, look what happened in stocks last 15 years. So I'm still willing to bet that even though we're above this high, that at some point we're going to have a very vicious bear market where the market falls 50%, 60%, like 2008, 2009, and we're going to go lower. And I know that everyone's excited about Trump and excited about all his policies and all this sort of thing. But my opinion is, again, we are now at such extremes. Like even you can see here in 2021, if you just said, okay, I like by the end of, by 2021, this is too high. Okay, you missed that last year, but then we declined here. So you have to look at other things like sentiment, what the Fed's doing, all that sort of thing, to kind of get on board with the stock market. So this is, like I said, this is a longer term indicator, but I'm willing to bet that kind of again, the 70s, this was basically an 8-year move. This move that's basically happened since, let's say, 2019, a 5-year move, or let's say, let's go back 8 years, 2016, when we were at 120%. This is going to about look at as like this huge, huge move where even though that sounds like a long time, even though we've had big bull markets in between, it was probably a time that you shouldn't have been really buying stocks. And back in 2016, you could have been buying gold, you could have been buying a lot of commodities that were very cheap at the time, 2015, 2016. So, I think in the longer term, if we go out 15 years, going say to 2030, you're going to see that if you would have been buying in 2016, you're better off buying those assets that were actually cheap as opposed to stocks that were starting to get expensive. So now the one thing we don't know is that we do have a really high inflationary cycle. Maybe this indicator doesn't matter anymore because people get into stocks as an inflation hedge. Stocks are an inflation hedge, just like gold is, just like real estate is. Those real assets do go up in hyperinflations. Ask anyone in Argentina or Venezuela or Turkey. So in domestic terms. So I don't know. So, but look, I do know now we're not in that hyperinflation mode. We're at 202% of GDP. And I just think that means that we're going to have a very bad bear market at some time. The Fed is already talking about not, cutting rates as much. It's 50-50 now for December. So that kind of tailwind is kind of disappearing too. So let's watch what happens here. But I have to say, despite the fact, you got to throw your politics aside. Hey, politically, I'm more of a libertarian conservative myself, but this is extreme. I'm raising cash right now. I'm just going to be, this is where you got to be boring. I just going to be boring. Like, okay, I'll do maybe some shorts. Maybe I'll buy some precious metals on this pullback, but it's to me, it's just I just want to wait, like if you waited even here, definitely if you waited in 2000, like when over 100% is really anything, or especially over 120%, I consider really high. So if you've done that in, the summer of 1999, okay, you missed that last big run, but you also missed this, and then, we got stocks at pretty fair or cheap levels by 2023, and then at super cheap levels in 2009, you know, that was basically the cheapest level in 2009. That was the cheapest level really since the early 90s when this big bull market started. So that's today's stock chart of the day. Like Buffett indicator, all-time highs. Time to be very cautious. Throw your politics aside, etc. Everybody take care.